I spent years on Wall Street covering retail, and I learned pretty quickly how the game is played, how the numbers get spun, and more importantly, how to spot a lie in a press release. Today, we're going to peel back the layers on these 2025 holiday sales numbers, and I'm going to show you what's really happening to the American consumer.
This quote, this just says it all, doesn't it? The headlines are all celebrating this huge victory, but it's a victory paid for with phantom money. You see, they're cheering for the spending, but they're completely ignoring the mountain of invisible debt that's funding the whole thing. Let's dive in. So, the headlines are shouting from the rooftops about a record-breaking Black Friday, $10.8 billion. That sounds amazing, right? But it's dead wrong. That's the myth. The reality? When you actually factor in the cumulative inflation since 2022, which is a lot, real spending is actually down 6%. People are spending more dollars, but they are taking home fewer goods. It's that simple.
And that brings us to the one central question, the one that completely blows this whole narrative apart. If Americans are really on some historic buying spree, why are the arteries of commerce, the shipping companies, seeing a drought? It just doesn't add up.
Okay, look at this. This right here is the smoking gun. You can play all the games you want with dollar figures and inflation numbers, but you can't fake the number of physical boxes moving across the country. Both UPS and FedEx are reporting that their shipping volumes are down a staggering 9% from last year. This is irrefutable proof. Fewer items are being bought, packed, and shipped. Period. The story of a retail boom completely dies on this slide.
And get this. Of the few items that are being shipped, a huge number of them are coming right back. Early data is showing a 30% return rate for Cyber Monday. This isn't confident consumer spending. This is the classic signature of buyer's remorse. It's what happens when that little dopamine hit from a debt-fueled purchase wears off and the reality of the bill starts to set in. So you might be asking, how are financially strapped consumers funding even this reduced level of purchasing? Well, the answer is a new and pretty dangerous financial product I like to call shadow debt. Seriously, think of buy now, pay later as the subprime mortgage of 2025. It's short-term, it's unsecured, and, this is crucial, it isn't immediately reported to credit bureaus. So the Fed, the banks, the economists, they can't even see it yet. It's a massive blind spot in the economy. And here is the sheer scale of the problem. This holiday season, a full 18% of online transactions were funded by services like Affirm and Klarna. Now that's up from just 7% last year. This is not organic consumer strength. It's a debt-fueled illusion. This explosive growth is the only thing propping these retail numbers up.
And this timeline, this shows you exactly when the hangover begins. People bought stuff in late November. The first easy little payment hit in December. But the final, much larger installments, they come due in January, and that's when we're going to see a wave of defaults from consumers who, frankly, never had the ability to pay in the first place.
Now, this isn't just some theoretical problem for consumers down the road. It is having a direct, brutal impact on the retailers themselves right now. But not all of them are feeling the pain equally.
What we're seeing is a classic recessionary signal, the Great Bifurcation. On one side, you've got a store like Target. Their stock is getting hammered because they sell discretionary items. The stuff you want, not the stuff you need. They're seeing demand just evaporate, and they're already canceling orders for next spring. But on the other side, you have Walmart. Their sales are strong. But do you know why? Because high-income shoppers, people making over $100,000 a year, are now trading down to Walmart just to buy groceries. Let me tell you, when the rich start shopping at discount stores for essentials, you know there's big trouble.
And for all those retailers caught in the middle, your Macy's, your Kohl's, it's a catastrophe. They ordered all this inventory based on those fake optimistic forecasts, and now their warehouses are overflowing with unsold goods. So the crucial point is this: get ready for a wave of going out of business sales in early 2026.
And if that buy now, pay later story wasn't frightening enough for you, just look at this. A full 40% of shoppers are admitting they used saved gift cards or credit card points to pay for gifts. This is not spending from income. This is the liquidation of saved assets. People are literally draining their last reserves just to get through the holidays. It's the very definition of unsustainable.
Okay, so let's zoom out for a second. Because this rot that we're seeing in the retail sector, it's just a symptom of a much bigger disease that's affecting the entire U.S. economy. This slide right here shows why this matters to every single one of us, even if you don't own a single retail stock. Consumer spending is 70% of the U.S. gross domestic product. 70%. If that spending is fake, if it's built on a mountain of shadow debt and disappearing shipping volume, then the entire economic foundation of the country is standing on quicksand.
And here's how this spirals into a vicious cycle. Look, retailers aren't stupid. They see the real data, the low volume, the high returns. So what do? They lay off their seasonal workers weeks early, right after the holiday rush. Then all of a sudden, January unemployment claims tick up unexpectedly. That spooks the market, and of course, those newly unemployed people stop spending completely, which just accelerates the downturn.
Okay, so that's the diagnosis. And yeah, it's bleak. But I'm not here just to deliver bad news. For those of you who can see the reality behind the curtain, there are ways to prepare and even position yourself for what's coming.
So here it is, the playbook for the first quarter of 2026. First, you short the mass market retailers that cater to the squeezed middle class. An ETF like XRT is a broad way to do it. Second, you go long on the discount retailers like Walmart and Dollar General, who are going to benefit from all these consumers trading down. And finally, you avoid luxury brands like the plague. The wealth effect is over, and they are about to face a brutal, brutal reality check.
So what's the ultimate takeaway from all of this? Forget the happy talk you're hearing on the news. Forget the record-breaking headlines. Look at the shipping containers, look at the shadow debt, and look at the inventory piling up in warehouses. The consumer is tapped out, and the bill is about to come due. Come January, come February, take a drive to your local strip mall. The for lease signs are coming.